Hi everyone, JJ here with The Art of Value. Welcome. Well, today we're going to look at the GOAT, Warren Buffett, some of his best rules for investing. He's been talking about them for decades. They're not that difficult, quite simple, but not many people can actually seem to follow through with them. Let's see what they are. Buffett's first rule of investing is don't hold a stock for 10 minutes unless you're willing to hold it for 10 years. Seems like a simple rule, a simple plan, but not many people actually seem to follow through with it. It's harder than it seems. This is what Buffett actually said about this, straight from the Oracle of Omaha's mouth, so to speak. He said, you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm, and never look at a quote. You don't need to pay attention to them. So here Buffett's talking about the importance of the psychology of investing, behavioral investing, where you just need to buy a stock and hold it for 10 years, which is difficult when you look at a stock ticker every day, you're following it. You get fear sometimes when it goes down. It'd be better not to look at it. He thinks for 10 years, just leave it alone, like you would buy a farm. You can't get out of that quickly. You don't look at how much it's worth every day. You just hold on to it. They might look at them from time to time just to check that they've still got a wide moat and that they're great, wonderful businesses with great management that he looks for. But other than that, they don't touch them. They're not looking at the stock ticker every day. They don't gamble with these stocks. They're just holding long term for the very long term, and they don't care if it's 40, 50 or more percent of the portfolio even. They're not afraid of that because they know it's an excellent business. And Buffett talks about the temptation to sell a stock when it might plunge if you don't have conviction in the stock and you're not willing to hold it for a long time no matter what. He says you've got to be prepared when you buy a stock to have it be down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out 3 times in Berkshire history when the price of Berkshire stock went down 50%. There wasn't anything wrong with Berkshire when those 3 times occurred. What he's saying there is every stock, even great companies, go down 50%. It's happened to Berkshire, to Amazon, many stocks that have gone down 50% or more. You have to be willing to hold during those periods, which is psychologically very difficult for investors, but if you're not willing to do that, don't buy it in the first place. One of Buffett's psychological tests for conviction is that he said you shouldn't care, it shouldn't matter if the stock market closes for 5 years. If it closed for 5 years after you bought a stock, you shouldn't care about that. It should be fine. You shouldn't have to look at the ticker and manage it through that time. You should not care and just walk away and come back in 5 years and you'd be happy to do that. So Buffett's next rule is don't lose money, which may seem like a bit of a joke. People don't really take it seriously, but his serious intent behind that, what he means is this. He says the first rule of investing is don't lose money, and the second rule of investing is don't forget the first rule. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money. So what he's saying there is buy things below what they're worth, below intrinsic value, which we'll talk about. And that's, of course, where analysis comes in, to analyze companies to see what they're worth and make sure you're paying below rather than paying too much. So if you make a mistake on that, you're not going to lose money, is really what he's saying there. If you pay up too much thinking it's going to be great and something goes wrong, you just made a mistake. You made an investment mistake. Everybody makes mistakes, even Buffett. So it's a protection against making mistakes, but it's also a way to make the most money. If you buy low and it goes up a lot, if it recovers and goes high, then you'll make more money, which is how he's become rich over the very long term. And that is Buffett's next rule: always buy below intrinsic value. What does he mean by that? There are many different ways of calculating intrinsic value or approximating intrinsic value because it's not a perfect measure. Every investor will likely come up with a different intrinsic value for any company. It's often said about valuing a company, about paying for it right now, is that we're looking at the future cash flows of that company and discounting it back. So what's it worth to pay for those future cash flows of the company right now? And many things can happen in capitalism. We don't really know the future cash flows of the company 10 years out. It's pretty impossible, even 5 years. Stuff happens in capitalism. It's brutal. It's very hard to know where a company will be in 10 years, what the cash flows will be like. Many people think that they can. If it's a growth company, it's really difficult. There are so many different variables that can change. Things can go wrong that we didn't expect. A lot of growth investors are very optimistic about, say, what's going to happen to Tesla over the next 10 years, what the cash flows are going to be like, what the market cap's going to be like, what's it going to be earning in 5-10 years. It's very difficult to know. I think it pays to be very conservative about that. What could go wrong and protecting the downside as well as thinking what could go right. So it's about what we think would be comfortable to pay for those future cash flows of the company to get a decent, a good rate of return over time. What will we pay for that company? That's what we need to think about. That's what analysis is all about. Now, if you're getting value out of this episode so far, do think about subscribing if you're not already to get more of this kind of content in the future. And thanks to all those people who have subscribed already. Buffett's next rule is staying with businesses you understand within your circle of competence. If you don't understand the business, you're certainly not going to be able to calculate or approximate its future value or its value today. And so you're just gambling at that point. Stay within your circle of competence. It's tempting to go outside of it with the latest, hottest thing, but if you don't know what you're doing, you need to stay away from that. So Buffett puts it quite simply here. He says about evaluating a business, evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, and I understand the competitive aspects of the business. All those very important when analyzing a business. Competition is very important. Of course, he talks about a moat or sustainable competitive advantage. That's what he means by competition there. On the importance of the circle of competence, Buffett says this. He says, defining your circle of competence is the most important aspect of investing. It's not important how large your circle is. You don't have to be an expert on everything, but knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about stocks that are going up and everything, I start fooling around someplace else. Eventually, I get creamed, and I should, he said. So staying inside the circle of competence, don't get seduced by glamorous stocks that you don't understand, is what he's saying there. Buffett's next rule of investing is don't buy cigar butts, which he used to do, and he got this from his teacher, Ben Graham. He explains this with a story about walking along a street and seeing a cigar butt lying on the ground. It's all soggy and disgusting, but you pick it up and have that last puff because there's one last puff. It's cheap or free in that case, and he's talking about this in terms of companies. So they may not be good companies, but they're cheap, so just buying cheap stocks, which is what Ben Graham often did. So you can make money out of it, and you sell it, and then you find the next cigar butt. He used to do this over and over, but that's the trouble. Instead of buying a compounder or a good quality compounder company, you buy a not a very good company and you take that last puff and then you sell it on. This is what he used to do. He said you can make money out of it, but you have to do it over and over again. So now he wants to buy wonderful businesses at fair prices rather than fair businesses at wonderful prices, which is that cigar butt method. And Charlie Munger taught him this, or convinced him of this over time, that it was better to buy a wonderful business at a fair price and just hold on to it to compound for the long term instead of buying these cigar butts over and over again. It's much easier to buy these long-term compounders. You just have to find them and get them at a fair price, which is not easy because the wonderful businesses aren't often at good prices or even fair prices. They're often overpriced because everybody knows about them quite often. So the holy grail is finding a wonderful business at below intrinsic value or a low price. If you look at what Buffett has done over the years and Munger, they often have found businesses below intrinsic value at less than a fair price, but they do say it's okay to pay a fair price. What is a fair price? Well, of course, that's open to interpretation, and that's what analysis is all about. So the next rule is a famous one. I'm sure you've heard this before. Be greedy when others are fearful, and be fearful when others are greedy. So when the stock market plunges, as it did in 2022 and also early 2020, those are the times to buy. When there's a lot of fear around in the market, and people are too scared to buy. People are selling rather than buying. This is the value investing trait, the temperament that lets value investors go in and buy when others are fearful, when everybody's selling. And that's what Buffett has done many times. It's made him very rich over the time. And this is where it's not buying at fair value, it's buying well under fair value. So part of this is analyzing companies ahead of time, working out which are the good ones, thinking I might want to buy that later, but it's too expensive right now. And when the whole market plunges, as it does infrequently, that's a time when he goes and buys, like the financial crisis, the great financial crisis, the global financial crisis, the dot-com bubble crash is another time, and early 2020, which was only a few weeks window there before it shot back up again and kind of went into a bubble territory. So there's been extremes in the last few years. 2022 was a bear market. I think that was not a bad time to buy. It wasn't really low, but definitely some of the stocks, some of the tech stocks went down 70, 80, 90%, but people had bought earlier on. Lots of people had bought earlier when the multiples were high, interest rates started going up, and the stocks came down, but a lot of people had no money to buy them then. That's when value investors would look around in the debris of a bubble and see what is actually good business and buy it then. It would be like buying Amazon after the dot-com bubble bust, seeing that it was actually a good business, and then buying it and then holding on to it for a very long time. Buffett didn't do that, but he has done that with many businesses. And this has led naturally to the next rule, which is seize the golden opportunities. When those big stock market plunges, those are the golden opportunities. When people are extremely fearful, blood in the streets, they say, financially speaking, that's when to buy. And those are the golden opportunities, and they don't come along very often. It might be a big stock market crash about every 10 years or not even that. There seem to have been about that in recent decades, but sometimes it's not as long as that. And in individual stocks, when a stock plunges for a temporary reason, as long as it's not a permanent reason, and by analyzing it and working out that it's a quality company, you know that it's just a temporary reason, and Buffett's confident in that, and he will go in and take the golden opportunities. And when the golden opportunities come along, he's known to say, put out a bucket, not a thimble. When it's raining gold, put out a bucket, he says. You do have to have the money to invest at that time when those opportunities come along, but that's one of the reasons that he's become one of the wealthiest people in the world, by waiting and not just buying anything, working out what the quality companies are, and when the opportunity comes along, put out a bucket, swing big at those opportunities, and then just hold for the long term. And Buffett says about the few great opportunities you get, he says you've really got to grab them when they come along, because you're not going to get 500 great opportunities. There are only going to be a few, and you've got to wait, and you've got to grab them when they come along. Be confident, be ready, and grab those opportunities. Now, what he says about missing opportunity, the mistakes he's made, he says the biggest mistakes we've made by far are mistakes of omission, not commission. I mean, it's the things I knew enough to do that were within my circle of competence, and I was sucking my thumb, and those are the ones that hurt. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. I knew enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting, but I know the cost of it. I know I passed it up, and those are the big mistakes. So he's talking about not taking the big opportunities, missing out on that, and he knows it cost him billions of dollars, and it never shows up, doesn't show up in the portfolio, doesn't show up on any balance sheet, any financials, because it didn't happen. It was the opportunity cost. So those were some of Buffett's best investing rules. Some of them seem simple, but as I said, pretty hard to carry out, to execute in practice when things happen in the market, things happen in life, missing opportunities or fear and greed, whatever it is, for reasons that people don't carry them out, don't hold stocks long term. There are many of these things that are very hard to do in practice, but they're pretty simple rules when it comes down to it, and he's stuck to them and has become very wealthy because of it. Now, if you're interested in seeing more insights from Warren Buffett, I've made previous videos, which I'll put here if you're on YouTube, and in the description if you're elsewhere. And thanks for watching or listening, and I'll see you in the next one.